Welcome back, friends, for one more update from the world of high-growth EV stocks. In case you are new to this channel, please do consider subscribing. Now let us get right into it. Nio has a massive event coming up on Monday, March 1st, when it announces its fourth quarter reports. So we thought we should round you up with what you might expect from Nio. Nio shares are currently in bear market territory, having fallen over by an incredible 27% from a recent high of $64.60 on February 10th. The pullback came amid broader market weakness, as investors rotated out of the tech and related sectors in droves. The sagging stock has an upcoming catalyst in the form of its fourth quarter earnings report, which is due Monday, after the market close. Nio is expected to report a narrower fourth quarter loss of 7 cents per share, and revenues of a whopping $1.01 billion, according to latest consensus estimates from the Wall Street. In the same period last year, the company reported a loss of 39 cents per share, and revenues of $406.99 million, and in the preceding third quarter, revenues were at $666.6 million and the non-GAAP loss per share was 12 cents. These estimates just show how rapidly Nio has been growing. Nio, meanwhile, it might be important to note, has given a fourth quarter revenues guidance of $921.8 million to $947.9 million. So, the investors will be watching closely how well Nio manages to beat its own top-line estimates. Now coming to vehicle delivery numbers, Nio confirmed in early January that it delivered 17,353 vehicles in the fourth quarter, which is a 111% year-over-year growth. The momentum accelerated further in 2021, as January deliveries climbed over 350% to 7,225 vehicles. It may be worth noting that Nio's forward outlook looks very solid. Nio is operating in a market that presents a huge opportunity. Electric vehicle penetration, which is currently only at 3% of global new vehicle sales, will increase to 50% plus over the next decade. This presents outsized opportunities for EV-first automakers. China is perhaps the most crucial part of the global EV growth story. Nio has been proactively pushing ahead and expanding its market share. In addition to the 3 commercial vehicle models it currently sells, the company unveiled its first EV sedan, named ET7 at Nio Day, on January 9th. The event also saw the rollout of several new products and offerings, including its new battery swap technology and autonomous driver assistance system as a service. Competition is getting intense, with more players entering the domestic EV market. Incidentally, Nio is also nurturing global ambitions and has hinted at exports to Europe. Leading into the Q4 results, we have some more positive data coming from the Chinese media. According to latest reports on sales data for China, Nio SUVs are ranked number 1 from the last 1 month, significantly ahead of both Tesla and XPeng. If we translate the Mandarin text to English, this is what it says: at the beginning of each month, the major car companies will release the previous month's sales. However, compared with the model sales data released by car companies, the number of car insurance is more accurate. These are the cars that are really handed over to the owners, and they are the most valuable data. Therefore, the insurance number is also the key to measuring the success of a model. In more long-term positive news out of China for Nio, it is now confirmed that from January 1, 2023, the city of Shanghai will no longer issue free special license plates to users who purchase plug-in hybrid vehicles. The decision was made by the eastern Chinese city in the report titled Shanghai Implementation Measures to Encourage the Purchase and Use of New Energy Vehicles, which was released only last week. This means that starting in 2023, Shanghai consumers who want to purchase the Li 1, the only model under Li Auto with the extended range technology, will first need to obtain a license plate for a gasoline vehicle. Shanghai currently issues gasoline license plates through very difficult and time-consuming auctions, with 233,761 people participating in January, of which only 5.7% received a plate, with the lowest price sold at RMB 91,800. In other words, the city of Shanghai is trying to discourage Chinese people to buy even hybrid vehicles going ahead, and get only pure EV cars instead. Needless to say, the move is a fantastic news for Nio.
Individual level, we can look at tech companies and say there may be some companies that are going to be pushing valuation levels, but on a broader scale, the Chinese government is clearly aiming to support the digital economy technology, made that statement in its 14th five-year plan. So you have that much broader support, I think, going forward, and that acts as a continued, whether it's catalyst or benefit to the technology sector is probably an open question, but it certainly will support it.
You make the point, Alex, that China is set to lead EV development for the next 20 years. So you've got to be exposed to the likes of Geely, Nio, and Li Auto, to name a few.
Yeah, I mean, we're positive across China and also Asia portfolios on looking at the impact that the broader move towards sort of climate-related technology is bringing us. And certainly within China, when you then add that onto the carbon neutrality pledge by 2060, peak kind of carbon by 2030, there is a very positive outlook for that green sector within the Chinese economy, and it's an area that we continue to look and across a number of portfolios favour certain companies that we see as either leading in that or offering good long-term opportunity.
1 year after its trading debut at $6.26, the perfect storm tanked the company's stock to below $2 at the end of September 2019. The cash-strapped company couldn't pay its workers on time at the start of 2020, but then the tide began to turn. Help came in the form of a $1 billion lifeline from the local government of Hefei in return for expanding its existing operations, including the creation of a new headquarters in eastern China. As China's economy rebounded after the first wave of the COVID-19 pandemic, so too did Nio. In March 2020, the Chinese government announced that it would extend its subsidies and a tax break for new energy vehicles, which include pure electric and hybrid cars, to 2022. This has led to a bumper year for EV manufacturers in China, with 1.1 million electric vehicles sold in the first 11 months of 2020, up 3.9% from 2019. Nio delivered over 35,000 vehicles in the same period, more than twice as many as the year before. But the company got a boost from an unlikely source. Thanks to the world's most valuable automaker Tesla, Nio's fortunes were turning around. In 2020, Tesla's stock price had jumped nearly sevenfold. The surge encouraged investors to look for opportunities in other electric automakers. Some concluded that Nio was the next best competitor. As the company's stock price soared in 2020, Nio became the fourth most valuable automaker in the world, surpassing General Motors and Daimler by market capitalization at the start of December. Sales of electric vehicles are expected to increase from 2.5 million in 2020 to 11.2 million by 2025, before nearly tripling to hit 31.1 million by 2030. By 2030, Chinese manufacturers are expected to command 49% of the total global EV market, while European firms will take 27% and the American companies 14%. It is no wonder then that Nio has Europe in its sights, followed by other global markets in 2023.
As always, thanks for tuning into this update. And if you haven't yet watched our beautiful compilation video on the Nio CEO Li Bin explaining the big future visions of Nio to the Western media, please do check out the video from the link on your screen now.